Stocks closing near the flat line as the tech-led rally shows some signs of fatigue, while investors also assess the broader health of the economy and the path for interest rates. Here to discuss all of it is Nancy Tengler, CEO and CIO of Laffer Tengler Investments. Good to see you, Nancy.
Thanks for having me, Julie.
So I know that you guys, I want to start with tech and that sort of divergence that Jared was just highlighting. I know you like some big tech names, but I am curious if you're seeing those signs of fatigue as something that are going to last a little more, or is it just brief?
I mean, I actually hope, because this is the way the market works, that we get a correction that will clear out kind of all the rubble. We get 10% every 12 months on average, and we haven't had one for a while. So I think it would be good for markets, but I don't know that we're going to see that.
What's the catalyst for that? I mean, it could be the Fed, and we'll get to, you got some really interesting comments about the Fed I want to get to, but what is the catalyst for a correction here?
I think when all the hedgies go to the Hamptons.
And that hasn't happened, or is that in process?
I think
it's a little early, yeah.
There'll just be a lack of, it'll be a buyer strike. And I think, that makes sense if you're a short-term focused trader like the hedge fund and algo guys are. We're long-term investors, so we use that volatility as an opportunity to step in, as we did in the fall of 22 and the fall of 23. Certainly there's names we've been trimming, but I still like the trade. My analogy has been pretty clear back to the 90s when I was managing money. I don't think either one of you were born yet, but
that's very kind of you, Nancy.
But it was a productivity-fueled growth run, and I think a lot of similarities: higher inflation, above 3% for the decade. 10 years between 5 and 7%, labor shortage.
Doesn't matter what the Fed does.
Inverted yield curve didn't matter what the Fed did, and so I think that we are there, and we're not at the 1999 end of the decade. We're in the middle of the decade. We've been writing about this for over a year, and I think a lot of other people are starting to join in on that chorus, which I don't know if that's good or bad, but.
So does it matter what the Fed does?
No.
No, just full stop, it doesn't matter what the Fed does. Why not?
Because if they cut, and I think they probably will, they're going to cut once, maybe twice, and there's really no major movement in that. And so when you go back to the 90s, Chairman Greenspan understood what productivity did for inflation. And so he raised aggressively in 94, he cut twice in 95, once in early 96, and then let it ride for a couple of years. And I think that's why I believe higher interest rates and robust stock performance can coexist.
You're talking about Greenspan. That was the age of irrational exuberance. Sometime around there is when he coined the phrase.
Yep.
But you're talking about the current Fed, and I love what you're titling one of your notes here. Data dependent is the new transitory. Has the Fed just stepped in it here again?
I've been so critical. I'm starting to get pushback, but I think, they waited too long. We know that, to raise rates, and then they flip-flop on so many issues. And I thought the really interesting parallel was Christine Lagarde at her press conference was, she must have said data dependent 20 times. She also raised the inflation estimates and cut interest rates. And their primary criterion for cutting rates was if wages rolled over, but they actually went up. And we're kind of in that same environment here. Where at the last press conference, the chairman said, 2.6 to 2.7 isn't a bad place to be in regards to inflation. That to me was a cue. And then the press conference before that, he talked about, if labor softens, we're gonna get in there and act. And labor is rolling over. So I think they are itching to cut.
Yes.
They raised their inflation estimate too for this year and next year, but the cut's still on the table. So I think Fed speak is not worth
parsing.
Yes.
A hill of beans?
Yeah, and maybe a hill of beans. Like, you shouldn't let it drive your portfolio decisions.
So something you also said in this note that it was interesting, because Mohammed Al-Arian, it's also been a refrain of his, is he also thinks the data dependence is too backward looking.
Yeah.
And he's looking at what companies are saying and listening to conference calls, which I know you were doing also.
Yes.
So what's your takeaway from what companies are saying?
Oh, I love being on his team.
It's a good place to be, by and large.
He's always right. So what we've been hearing is beat, and raise. And not across the board, because certainly there were companies got nailed, but generally speaking, across sectors. And so it matters which companies you own, which management team teams you're betting on. But we saw from the companies, especially in our 12 best ideas portfolio. So think Chipotle, think. Now, of course, I'm not going to be able to think. Well, Microsoft beat and maintained. Amazon beat and raised. And so we had a number across segments that Goldman beat and raised. So these are in our 12 best ideas portfolios. But then outside of that, in industrials, we saw it, in some consumer discretion. So there are a lot of opportunities to make money if you're buying companies that are growing earnings.
And your investment thesis, your theme has been investing in old economy companies that have pivoted to digitization, cloud computing, generative AI, cloud computing, and the suppliers of the picks and shovels. So that's kind of what we're talking about here. How far does this go? What's the logical conclusion of this?
Well, it's been our theme for 2 years, and so somebody said to me, well, you haven't changed very much, and we don't. I mean, these are long-term secular tailwinds. So think about Walmart and the improvement that they've seen in margins, in same-store sales comps, in earnings growth, and it's been driven by digitization for sure, robotics, also generative AI in their advertising business, and then e-commerce, of course, cloud computing there. Same with Amazon. So you can go across old economy companies, and Emerson Electric is another one of our holdings that is automating data centers and industrial complexes. You can look at Carrier that's going to cool those data centers that are getting built like crazy, and you can also look at a company like Quanta Services, which we own, which is building the infrastructure for the electrical utility expansion. I mean, I could go on forever, but these are companies that have pivoted, and those are the ones we want to own. So I want to own a Walmart over a Target, for example.
Yeah, a lot of good ideas for people. I'm curious though, as we talk, you're not worried about the Fed, upsetting the apple cart. What are you worried about? Because it sounds like you're pretty bullish here. So what's
I'm worried about the consumer, and in our ETF TGLR, we reduced our exposure to discretionary names because we think, and we reshuffled it a little bit. I think the low end consumer and even the mid range consumer is getting squeezed. If you're a non-managerial worker, it takes you 71.5 hours to pay your mortgage every month. Your average hourly earnings have gone down. Your savings rate has gone down to 3.6% versus 6.1 pre-pandemic. Credit is becoming hard to find. But what may happen, and we saw it with the industrial production numbers, you may see the manufacturing side of the economy pick up some of the slack a little bit.
Why, if all of this is happening, why hasn't inflation come down more?
Oh, it's so sticky. So housing is on its way back up. And I think it's because of the fiscal spending at the government level. It's really fueled the flames of inflation.
But the fiscal spending, we're over that, why aren't we over that, I guess?
Yeah, well, there's a lot that still hasn't been spent, and I think it's embedded. Like if you've got the Treasury financing huge amounts of debt at the short end of the yield curve, that increases and sucks capital out of the regular economy by having to service the debt. We're going to pay $870 billion, according to the CBO, to service debt this year. That means it's going to be probably $1 trillion because their estimates are always wrong. So that becomes another factor because companies are still spending. In our clean energy infrastructure strategy, we've got companies spending like crazy on manufacturing construction's at a historical peak. We've never seen it this high. That creates a multiplier effect in the economy, and I think it's going to continue. And last thing I'll say is, if the Fed doesn't cut rates, housing is going to continue to be constrained, and the prices of equivalent rent is going to go up as well as housing prices.
Yeah, my rent just got increased by 20%, so I'm right there. Yeah, seriously.
And it's cumulative, right? So you've got, like in Arizona, where I spent half the year, you've got home insurance prices have gone up 62%. Mine have gone up closer to 80 since January of 2020. So to your point, it's cumulative, it's embedded, and that's why I think it's going to stay sticky for a while.
Nancy, really great to have you here on a Friday afternoon and talk Greenspan as well.
Thank you.